All right, so this guy, case 5, is an entire income statement. It's combining the stuff that we learned in module 5 with some of the items we brought in module 6. So it's a nice comprehensive problem. This and case 4 are very similar to one another. So take what you hear or take what you learned from this video and then apply it and see how you do with case 4. So we just have a listing of income statement items, right? These are all pre-tax amounts as identified. So some of them we're going to have to turn into net of tax amounts. Some of them are okay to keep as is until we get to taking a tax from all of them on the tax expense line item. And the first one is very similar to what we've seen in module 5, where you are basically coming up with subtotals on an income statement. For part B, this is similar to what we did just in case 1, where we have some additional information going on about dividends, about an underreported depreciation expense and an underreported sales revenue, how that's going to affect one of these accounts. And then finally, we have some EPS disclosures. So the first thing that I suggest is making a income statement, right? So starting off with sales revenue, that is, of course, the very top of my income statement. This is an operating income item that increases my income. This is obviously the main income item. Again, I'm going to drop zeros just so I don't waste pen ink. But understand, of course, that there should be zeros behind all of these guys. Now, from sales revenue, we want to take cost of goods sold. That's also an operating expense. It just is separate from other operating expenses due to its prominence, due to just how material of an amount this is of my sales revenue. This is actually a very low amount for most companies. Like I mentioned, most companies have cost of goods sold between 45 and 55% of their sales revenue. So this is a modest cost of goods sold, which will create a rather high gross profit. In this case, I have a gross profit of 4,884. All right, so after we have gross profit, then we want to pull in all of the operating expenses. So we got this guy, and then we have cost of goods sold that we incorporated. So now we were looking for operating expenses. Interest expense is a non-operating item. Profit from discontinued, oh, sorry, I skipped one. Depreciation expense, that is operating. The profit from disc ops is a disc op item. So this is that, hey, we discontinued our operation, but it's still generating revenues and expenses. In this case, for this discontinued op, it had slightly more revenue than expense. So it had a profit from the discontinued operations, income from discontinued operations. Remember, profit, income, earnings are all interchangeable. The unrealized loss on the pension, that's OCI. Salary and administrative expenses, definitely operating. The gain on the sale of equipment, not the gale on equipment, is operating. So when we sell, remember, when we sell PP&E or intangibles, gains and losses from the sale of PP&E and intangibles is operating. Right? Gains and losses from the sale of investments, that's not operating. We have an impairment. I calculated the impairment for you. It's an impairment of a disc op. So it's a discontinued operations. Then we have two unrealized items at the very end. The unrealized gain on the available for sale is definitely OCI. Now, the unrealized loss on trading securities, because it's a trading security. Now, this is a distinction. Remember, trading securities are those securities I bought with the explicit intention of selling in the near future, recognizing some money, some profit off of the sale. Since it is intended to be sold in the near future, even though it's unrealized, this is going to still be incorporated as a non-operating item. Okay. It is included in net income, even if it's unrealized. The available for sale securities are not included in net income because the intent for those is not that we're going to sell it, right? We're not necessarily going to sell it in the near future. We might, but there's not a clear intent like there is with trading securities. Since the intent is clear with trading securities, that does affect net income. And so we do want it to affect net income because it will be realized very soon. We're intending on selling it. It will become a realized gain or loss once sold. And so we include it such that it affects net income. Now, working with that information, I can go ahead and finish out the income statement. We got gross profits. So next, of course, comes our operating items. You can list them in any order because it's an informal statement. Typically, SG&A comes first. So the item like salary and administrative expenses would be the first one to present if we were being very technical with our ordering. So that guy is taken care of now. What else do we have that's operating? We have depreciation expense that's operating, and we have the gain on the sale of equipment. So those two need to be put in there. Depreciation expense is 700,000. And the gain on the sale of equipment, right? Be careful when you're doing this. You can start, you can make a silly mistake. And just keep thinking everything should be subtracted. But of course, the gain is positive, so we need to add that 120. And we have the gross profit of 4,884 less 730 less 700 plus 120. So that brings me up to 3,574. And that would be my income from operations or operating income. So it includes all of my operating items that are both positive and negative and accumulates them together. Now that we have our operating items, we move into our non-operating items. Interest expense is one of those that we identified up at the top. And that was for 100,000. Again, you want to be careful. Don't make sure that you subtract it when it's an expense, add it when it's a gain. That's a silly mistake that I see that I myself make and I see other people make. And this trading securities, which is a gain. Oh, sorry, it is a loss. I don't see how it's mislabeled. It is a loss. So we have an unrealized loss on trading securities. That also should be incorporated. And that is for 160. Scan through and see if there's anything that we missed. No, so that's OCI, that's discontinued. OCI discontinued. It looks like we have it all. So then we take that income from operations, subtract off the two items that we just identified. That gets me to 3,314,000, but again, dropping the zeros. This is my pre-tax income. Now that we've had all the operating and non-operating items, that gives me pre-tax. So if it's pre-tax, that means I want to take a tax on it. The tax is 40%. So I take 40% of that 3,314,000. And that gives me a tax expense of 1,325,600 or 0.6 in this case, since we're dropping them zeros. All right, so now take the difference between that and the pre-tax. This is my income from continuing operations. Now, after we have our income from continuing operations, we're going to include our discontinued items. So the discontinued items that we identify here is there's a profit of 20,000 and then there's an impairment of 390,000. Now, these are both pre-tax amounts, right? And it was fine to include all of these items up here at pre-tax amounts because eventually we took that tax expense from all of them, from the aggregation of all those amounts. But since our discontinued op was not a part of that, it was not taxed, we have to take that tax out separately. So the profit from disc ops is 20,000, but after I take a 40% tax out of that, I'm only left with 12,000. The impairment is 390,000 loss. Of course, impairments are always losses. But after I take tax from that, it's going to become, let me do that one more time. I don't think I took the appropriate amount. It's going to become 234. Right? So these are both net of tax. Make sure you net taxes from anything that's after the tax expense line, right? Anything after this guy right here becomes a net of tax item. Got to bring those taxes out of it if they're in there. So we combine these. This is going to give me my net income. And that's another thing I often see students make a misconceive is that they think that net income excludes discontinued operations, but net income very much includes discontinued operations and very appropriate for the fourth coming up. Net income is 1,776 and 400. Right? Now that we have net income, we make that final step that we just added, right? This is all basically a review from module 5. Now we bring in that next piece from module 6, where we're talking about the OCI. And we identified 2 OCI items, the unrealized loss on pensions, 330. But this is pre-tax, so we have to take tax out of it. And the unrealized gain on the available for sale securities, 175. Was 175. We take the tax off of our gain and we're left with 105 remaining. So we had a loss net of tax. Again, remember both of these are net of tax of 198,000 from the pensions. And then we had an unrealized gain on our AFS securities for 105,000. So again, combining those two and applying them to our net income, 1,776,400 plus the 198 plus the 105 gets me 1 million. Let me do that one more time. Make sure my math is on. 176.4 less 198 plus 105 gets me 1,683,400, which is 10,000 off from the answer key. I'll have to fix that. Comprehensive income. So my advice in terms of studying is that you absolutely, I did something wrong here. You absolutely need to know the categories of these items, where they go. If you need to start a list like operating expenses, non-op items, non-operating items, right? What goes into these categories, right? But it's not enough just to know what goes in those categories, but because you also need to know these subtotals. And that is just basically learning the anatomy of an income statement, like what feeds into what parts, right? Um, you're just writing it, honestly, writing it over and over, just sales revenue minus COGS, gross profit minus operating expenses, income from operations, so on and so forth, all the way down. That will help you understand it, make sure you remember it. Okay, this is something that you just have to you just have to buck up and remember. And it's not something that, you're going to want to pull out in practice. I don't know why that keeps happening. You want to pull out when you're in practice, like, oh, I forgot how this works. Let me look at another income statement, right? Got to know it. All right, so we got that piece down. We got more than what was asked for. Income from operations, of course, would be 3,574,000. Tax expense would be drawing from this item right here, 1,325,600. Net income 1,776,400, and comp income would be 1,683,400. Going to the next part. Now we're going to use this information, combine it with some dividends, and then apply it to our AOCI and retained earnings accounts. And it tells us some information about dividends. It says there was $55,000 of common dividends and $75,000 of preferred dividends. So this is all dividend stuff. It wants us to provide the December 31st balance of the accounts after closures for the period, and to tell us whether, tell whether it's a debit or credit balance. The opening balances are provided to you. And it says also that the company discovered it had underreported depreciation expense by $70,000 in a prior period, and also underreported sales revenue by $20,000 in a prior period. So now we just need to, again, my advice, create a T account. And start with our beginning balances, 1,475,000 credit, 90,000 debit. To the AOCI, that one honestly is a little simpler if you know what side debits, losses and gains go on. We have an unrealized loss on the pension. That loss would go on the debit side of my AOCI account. We have an unrealized gain on AFS that goes on the credit side. And that will yield what the ending balance of that account is, 90 plus 98 minus 105, 183,000. So it would be $183,000 debit balance still. And the retained earnings, we have our net income. Remember to take net income. Now, you don't want to take comprehensive income. Net income is what's close to retained earnings. Always what you're updating the retained earnings account by is what we have, what we close to retained earnings. Similarly, dividends close to retained earnings, both common and preferred dividends, same routine. They both come out of retained earnings. So these will also reduce retained earnings. Now we have one other item, or two actually, that we need to attend to. So the company underreported depreciation expense in a prior period and also underreported sales revenue in a prior period. Remember, with prior period issues, when it happens in a prior period, that means that this number here, this 1,475,000, is contaminated by those prior period mistakes because we closed those mistakes out into my retained earnings. Now we underreported depreciation expense by 70 and underreported sales revenue by 20. These are sales revenue and depreciation expense are both pre-tax accounts, right? So those are pre-tax numbers. We have to make sure we strip the tax out of both of them. So the 70,000, 40% on that, the tax effect is 28, which leaves 42 as my net of tax amount. And then the 20, of course, 40% of that is going to be 8. And so that leaves 12 as a net of tax amount. 42 net of tax and 12 net of tax. Now the question becomes, what do we need to do to retain earnings from these mistakes? So this was underreported expense, and this was an underreported revenue. So if I underreported expense, then that means that my net income was too high because my expenses were too low, which means my retained earnings is too high, which means that I need to reduce retained earnings by 42 in this period. So I'm going to stick it over there on the debit side and reduce it. Now, if I underreported revenue, that means that net income was too low. And that made retained earnings too low. So I need to add that in on the credit side, that 12, that's the net of tax amount. I'll always take those net of tax amounts because in terms of net income is after tax, right? It comes after tax expense. So whatever this item was up here is diminished by the tax, and that's the amount that is ultimately closed into retained earnings. That's incorrect. So now that we've fixed or accounted for those adjustments, we have a full retained earnings account. And we just take 1,475,000, add 12, add the net income. And then subtract these three items, the underreported depreciation expense and the dividends. And that's, according to my calculations, comes out to 3,091,000.4. All right. So we got those two. That would be a credit balance for retained earnings, a debit balance for AOCI. We got those two. The final thing is about EPS. And the EPS is $1,000,000 or a million common shares, not dollars, because these are not dollars. A million common shares were outstanding during the entire year. And it's asking us to provide the EPS disclosures that we would need for this particular statement. So this is just an instance of, again, knowing what work to pull that you've already done. We need, because there's discontinued ops, we're going to need 3 EPS. So we're going to need the income from continuing ops EPS. We're going to need a net income EPS. And then we're going to want to show the effect of all of that discontinued op on the EPS figures. So we start off with 1,988.4. That's my disc op. We subtract off the preferred dividends. The preferred dividends were 75,000. Right. The common dividends we do not subtract because those are the property of the people, of the common shareholders. So that does not need to be subtracted, but we do need to take out those preferred dividends and then of course divide it by the shares outstanding. And since I'm dropping the last 3 zeros on these two, on the first 2 dollar amounts, I need to drop the last 3 zeros on the common shares. So doing this math, subtracting the 75 from my income before, my income from continuing ops, and then dividing that by 1,000 gives me $1.91 per share. That's my first EPS figure. The next EPS would be the adjustment of the discontinued op. So this one would be the 12 minus the 234, because that is the profit from the disc op. This is the impairment of the disc op. Divide that by 1,000. And that is negative 22 cents. And again, we could just directly solve for the amount by adding these two up. But what we can do instead too is just directly figure that out by taking the 1,776.4, subtracting 75, dividing it by 1,000. And I get 170. Some rounding error in there, it appears, but very close, right? And that is case number 5, all worked out. So this is a huge comprehensive problem that incorporates not just the stuff from module 5, but then brings in this OCI component, how that updates in the AOCI account. We have some new items from module 6 about the under and over reported income items from a prior period and how to adjust for those items, plus the EPS disclosures that we talked about in module 6.